How do the rich avoid paying taxes, and how can you legally do so as well through a financial planning approach? I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Have you ever wondered this? How do the rich avoid paying taxes? And you've seen lots of claims, and so-and-so's not paying any taxes, or this very, very wealthy individual or wealthy family, they don't pay anything in taxes. Or you look at the average tax rate of these other folks, you compare it to the average or effective tax rate that you pay, and you say, I'm getting ripped off, and 1%, and a lot of that is sort of externally focused, and there's a lot of negativity that comes with that as well. Well, I'm going to tell you, it's not that I, serve the Rockefellers or have some intimate, in-depth awareness of the wealthy's tax situation, but in general, there's a certain way that wealthy individuals, rich people, work the tax system to their benefit, and then there's the rest of us. But if the super rich have a tactic or use some rules to their benefit to avoid or minimize the taxes they pay, how can you play the same game even though you're just an ordinary individual or family? Okay, so here's the secret. Here's how the rich avoid paying taxes. And by the way, I think I would classify here. There's the rich and then there's wealthy. So who is it? I think the comedian, I think Chris Rock said, Shaquille O'Neal is rich, but the person that pays, that signs his paychecks, he's wealthy, right? Or they're wealthy. And so I would agree that the super rich are individuals that have this unique talent, unbelievable talent, and they get a paycheck for it. So you've got athletes, you've got entertainers, and they get a paycheck, and they might structure that through a business and through real estate in some ways that brings their effective tax rate down a little bit. But if you're just earning income, using your talent and earning income, well, then that's closer to being taxed and paid like the rest of us. I guess I'm talking about the super rich or the wealthy, the way Chris Rock would explain it. And for those folks, there's family money. And often it's connected to assets or a business or some sort of concentrated position of investments. And the way we would just think about it is, well, when they need to spend money, they just sell some of those assets, and that's how they get the money that they're going to spend to buy all their Louis Vuitton and all the, the extravagant lifestyle. But that's not what they do, because if they did that, then they would own less of that really valuable asset, and as they sold it, they would need to report it as income and pay capital gains tax on it, and then be subject to the additional Medicare tax, net investment income tax, and all that sort of things to really high degrees. Well, they don't do that. The super rich, the wealthy. Instead, they partner with banks and they finance, they leverage, they borrow against this really highly appreciated investment, whether it's real estate holdings or whatever it is, and they borrow. So they borrow and they spend off of that debt. Now, this would be very dangerous, financial, calamity for the rest of us. But for these individuals that own, that have assets that they don't want to sell because the appreciation has been and they project it to be really, really valuable, or they just can't sell. They own a very small portion of an enormous enterprise, family enterprise, and you can't just sell a little bit of that every time you want to go to the grocery store or something like that. Then they borrow it. Well, you can think through this and say, well, yeah, spending borrowed money, there's no income there, and you don't have to pay tax on that. It's wildly risky. It works if that asset, that pool of assets, continues to grow, that number one, and grow at a rate that outpaces the amount that you're borrowing. Because that growth then will help make that debt to asset ratio very easy and manageable. And the debt payment, that growing debt payment, seems manageable and small compared to that growing asset. So very risky. This is not something I'd recommend for the average person. I would say average person with a net worth of even up to $25-50 million. You've got to be well north of that to consider a strategy like this. But if that's what the super wealthy, so the super rich and the wealthy do, if that's, and that, yeah, that means they don't pay as much tax because there's not as much income because they're spending borrowed money. That's not the strategy for you and me. That's not. That would be financial calamity. That would be so much risk that it either works, and it rarely would, or you go bankrupt. And no one would. That's not a sustainable way to approach your financial life and sustainable financial success. So, how should the rest of us approach trying to pay as little tax as possible, or dare I even say, not paying any tax? Well, through creative tax planning, knowing the rules of the tax system and looking at your income and your financial choices and saying, what are the opportunities that exist for you to pay the least amount of tax over your lifetime, even multiple lifetimes, and aligning your decisions, your financial decisions, with those rules. And so no one has ever contributed to their 401k pre-tax and said, you know what, I don't want the deduction. I'm just going to include this money on my income anyway because I don't really want the deduction. No one's ever done that. So what are those rules that I guess what I'm pointing out is you're not going to understand the rules and then say, you know what, I'll just pay more than that in taxes. That's all right. That's all right. No. Understand the rules. And then which of those rules, which of them create opportunities for you to pay the least amount of tax over your lifetime in your unique situation? We do serve clients, lots of clients that have a chunk of assets, good income, and pay very little or no tax at all. And it doesn't happen by accident. It happens through planning. Tax planning is that proactive look at your overall financial world, your financial life, and saying, well, what opportunities exist for you to pay the least amount of tax over your lifetime? And through that lens of tax planning, combined with your present financial position, your protection plan, so your risk management decisions, your overall investment plan and investment portfolio, your retirement plan, Social Security optimization, all that sort of stuff, and your estate plan, when your tax planning is infused with those 5 areas, those 5 other areas of your financial life, then you're able to make unbelievably powerful decisions that really impact the amount of tax that you pay. So if I were to shine the spotlight on a couple, if you're pursuing this, oh gosh, I would love to find a way to not game the system, but be more proactive and either pay no tax in the future or pay as little tax as possible, pay a small amount of tax. What are the things that I would suggest you really look at and exploit? Well, the first is using the Roth IRA, Roth 401k. And you might say, no, that I'm paying tax up front. I understand, but you can put yourself in a position where paying taxes right now means you're not going to pay taxes ever again. Here's an example. Got an individual that I've been working with for, I don't know, maybe 10 years. And at the time, they had about $500,000 saved up. It was all pre-tax, but they were very focused on making sure that they managed their expenses and didn't spend a lot of money. And they were saving about the maximum they could every single year. And when we did our forecast, by the time they were going to be ready to retire, they'd probably have about $1.5 million. And believe it or not, that there was going to be around 65. They said, we're comfortable working until then. They've managed their expenses so well that Social Security at that time was going to cover a large amount of what they really needed. So saving up that 1.5, they really didn't need to draw that much out of it. Well, we started doing the math and said, you've been contributing pre-tax based on your situation, should you do Roth instead? And guys, this isn't me just sort of telling them, or being, influenced. I just want you to do Roth. We did the math and said, you know what, it actually makes more sense for you to contribute to the Roth. So at that point, we shifted and all new contributions were going into the Roth. That $500,000 then, we then staged out over the next several years to say, well, how can we do Roth conversions to turn that $500,000 that they have that's pre-tax and all the future growth on that, convert that into Roth as well. And we laid out a plan where we could do that at around $50,000 a year, keeping them within the 12% tax bracket. And as things change, we would either ratchet that up or ratchet it back or not do any, but that was sort of the plan. And this was many years ago that we laid out, that we crafted this plan. And here we are, we're really close to that retirement. And we've done the math where that $500,000, so ultimately the ratio is they've got just over $1 million saved up. Right now, about 2/3 is Roth and 1/3 is still pre-tax. And now we're doing the math to say, well, do we take this pre-tax and convert it, or when they turn on Social Security, if we begin drawing, if we let the Roth dollars ride and we don't draw off of them and we just draw a little bit from the pre-tax money to supplement and complement their Social Security, is it such that they would draw such a low amount that very little of their Social Security would be taxable to them, and they've got enough standard deduction to wipe all that income out, and they would be in a position where they don't pay any tax? That's currently what it looks like. So that's just one scenario, but it's been a decade or more worth of work, and things are going to change, tax rules are going to change, and their finances, their health will change in the future. We'll need to adapt, but leveraging the use of the Roth IRA and Roth 401k to help you put yourself in a position to avoid paying tax in the future. And then on the same lines, the second thing that you can do to really avoid paying taxes in the future is using that health savings account. And in the short term, so many people, and this might be appropriate in your situation, you fund that health savings account, and then as medical expenses come up, you use that HSA to fund today's medical expenses. And that's just fine. I'll take that over not using it at all, okay? But the pivot here, if you can and if it makes sense in your situation, is to max fund that HSA, and then as you have out-of-pocket medical expenses, still just using your out-of-pocket dollars as opposed to using your HSA. And this way, you're paying out of pocket today and you can save those receipts, and you save and invest and accumulate that HSA so the balance grows and grows and grows out there in the future. And then out there in the future, you can reimburse yourself. That's the way the law is written right now. You can reimburse yourself for expenses, medical expenses you paid from the time you had your HSA, or of course you're going to have out-of-pocket medical expenses out there in the future, and you can use it then, and all of that money that you're drawing out would be tax-free. And then the final thing that I would highlight as a way for you to leverage and pay the least amount of tax or put yourself in a position to pay no taxes, be aware of tax credits that you could be eligible for. First couple things that I would think about is the retirement savers credit. Now, this doesn't apply to everyone, but if your income is below certain thresholds and you save up to retirement, even to a Roth IRA, you get a tax credit. That's right, a tax credit that you don't need to repay for saving up for your financial future that you want to do and should be doing anyway. And so leveraging that retirement tax credit, if you've got kids, so the child tax credit, child dependent care credit, and if and when those kids enter college, the American Opportunity Tax Credit, leveraging all of those, being aware of those. And here's why I'm bringing that up. Because those tax credits are dollar for dollar reductions in the tax that you have to pay. And when you're aware and capturing as much of those as possible, then that might say, you know what, we reduced our overall average tax rate, our effective tax rate, and therefore now is a good time to be contributing more to the Roth or doing this to the HSA, those sorts of things. So you're sort of parlaying those two opportunities together. So how can you pay no tax? How can you put yourself in a position to pay no tax? It's likely going to be paying taxes, managing that while you're working, but then making great decisions during that time to put yourself in a position where you pay no or very little taxes out there in retirement for the rest of your life. It's not going to happen by accident, but you can get there doing the proactive tax planning work with your CFP doing comprehensive financial planning. If you don't have a CFP on your team that can help you with that, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.